2024 proved to be an exceptional period for investors. The U.S. economy showcased remarkable resilience, inflation in developed economies edged closer to the desired 2% target, and central banks worldwide shifted gears by beginning to lower interest rates. In addition, over 70 nations held elections, contributing to a year full of pivotal events. Now, while uncertainty persisted, global markets demonstrated strength and delivered solid returns. We're also very pleased with the performance of Matco's investment platform, achieving positive absolute returns across all asset classes managed. Here's how our funds performed in 2024. First, our Matco Opportunities Fund was up 40.7%. Our Global Equity Fund was up 16.9%. Matco's Canadian Equity Income Fund up 12.7%. Our Balance Fund up 11.3%. And lastly, our Diversified Income Fund up 3.7%. Now, as we look out to 2025, the challenge of excessive inflation over the past several years has continued to normalize in North America and globally. The risks of inflation and interest rates becoming entrenched at elevated levels hasn't completely disappeared, but it has diminished. Now, at the same time, economic growth is decelerating. While slower growth is typically undesirable, in the context of economies that were slightly overheated due to tight labor markets, this moderation is not only necessary, but it's very welcomed. The current challenge is to stabilize the economy at the slower growth trajectory. Successfully navigating this tightrope leads to a platform on the other side, one of healthy economic growth and well-balanced labor markets. But on both sides of this tightrope, however, lies risks. Geopolitical tensions that could disrupt economic activity, escalating trade wars, or the return of inflation. Other potential disruptions linger, leaving the economy vulnerable to setbacks. Now, amid these challenges, we do believe a version of a soft economic landing is the most probable outcome. Global earnings per share growth expectations for 2025 range between 7% up to 16% around the world. If these projections are overly optimistic, they still set a promising tone for the year ahead. However, this positive tone is accompanied by a U.S. market that does face concentration and valuation risks. The cyclically adjusted price-to-earnings ratio, as an example of the S&P 500, remains elevated at 37 times, which in and of itself does suggest more modest returns going forward. Critical developments to watch for in the year ahead. An upcoming Canadian election where a change of leadership does seem probable. Polls are heavily favoring a Conservative victory. This could unlock potential in the more cyclical sectors that have been held back: financials, energy, and industrials. Will it be enough to reinvigorate foreign direct investment in Canada? Time will tell. Secondly, the potential escalation of global trade tensions. Will President Trump's trade policies disrupt markets, or will they fall short of his rhetoric? Said differently, will his bite be as loud as his bark? Thirdly, diverging central bank policies where the U.S. Federal Reserve may remain higher for longer, while other global central banks move further into rate-cutting territory. Now, these uncertainties do reinforce the importance of maintaining a well-constructed investment portfolio. While the prospect for future growth remains optimistic, as asset managers, we do understand that complacency is not an option. Our focus, as always, is to manage our investment platform and our client portfolios through all market cycles. This does require balancing growth opportunities with adequate downside protection, finding sound investments while staying disciplined and not chasing expensive valuations. In 2025, we do remain as committed as ever to our risk management framework, cycle analysis, and our M-Factor processes to build resilient portfolios.